Hi everyone, welcome to Tuesday, and like we do every Tuesday, we take a look at the performance of the main board for the New Zealand Stock Exchange. Now, before we go and take a look, I have had notification come through from the Financial Markets Authority here in New Zealand, the FMA, saying that there are a lot of pump and dump scams going on at the moment. So just be aware, if you receive an offer or a notification, apparently it's coming through WhatsApp and some other social media channels. If you're getting an offer that seems too good to be true, it probably is. Now, the details around these pump and dump scams, the shares are what referred to as penny stocks, so they are only trading at a few cents. They are obviously pumping up the offer, too good to be true. It's an opportunity you don't want to miss. You know how they work. Now, do not be sucked into them. If someone is giving you advice like that on a share, they need to be registered financial advisors. They are the only ones that are allowed to tell you whether a share is appropriate or even offer shares available first and foremost. If you are receiving things like this, you do think, oh gosh, could this be an opportunity for me? Remember, you are welcome to share that information with me. I'm happy to take a look at it and come back to you. And in fact, I could even do a video on it to show others as to how these shares are particularly forming. I haven't seen one yet myself, but please be aware of that. The other thing as well with these videos that I'm doing, remember these are for educational purposes only, so they are teaching you how to do your own research. One thing I always say to people as well is I never ever listen to what I refer to as barbecue advice, and that's where it might be a friend or someone with good intent might be saying to you, hey, this is a really good opportunity, I've bought this myself. I do stress, do your own research. Or if you're unsure and you want me to take a look at it, I'm really happy to do that. But just be aware that there are these pump and dump scams going on at the moment. So they inflate the price by attracting investors to buy into them, and then what they will do is they will dump their shares, obviously at a premium. You're left holding a share that will all of a sudden tank, because with penny stocks like that, you don't need to have heaps of investors to actually start driving the price up. Therefore, when those scammers actually sell their shares, it will dump the price and the price will fall. I hope that's helped sing out. If you are not sure, I'm here to help you through that. So leading into that, this is for educational purposes only. No way is it intended to be personalised financial advice. Like I said before, you do need to go and have a chat to a financial advisor or a share broker. Let's take a look at the performance for the New Zealand stock market for last week. Right, here we go. We've got the main board for the NZX 50 up on the screen. I'm recording this on Monday morning, so the market is open and it's down about $14.43 at the moment, so pretty insignificant. You can see though, last week, look at that, we definitely did have quite a strong sell-off. When I look down at the volume on there though, there's not a lot. The volume was about 29 million. The previous week, being the week starting the 12th of January, there was a lot more volume. So you're looking at about 42.8 million. So just under double is where the shares were on that positive week. So that's actually a good sign. Nothing to get too concerned about at the moment. And you do quite often see that happen actually when a share or even an indices in this case has reached all-time highs. It is quite common that the indices or share will sell off a little bit. I think I've spoken about this before. It's a little bit like taking a breath out. So it's nothing to get too concerned of at this stage. We'll just take note of that. Now, I have got the HR down the bottom, which is the average true range or the average trading range. And I pop that on over a 21 period. What I'm looking at for the S&P main board here, and I do this for any ETF, iShare, or any indices, I want to see how much volatility there is in the market. So just taking that figure, so it's 217 and divide it by the share price of 13,452, works out at about 1.65% volatility. So that's certainly acceptable for an index like this. Anything 5 and above, then I like to just stay out. Let's put our moving averages on and take a look. So we'll use the 30 exponential. I like to use the exponential rather than the simple, just because it puts more emphasis on the performance of the latter end of the market than the earlier end, where if you use a simple moving average, it averages everything out over obviously the 5-year period. Whatever you use though, it's perfectly fine to use that simple moving average. It'll give you a similar result, but just stick with whatever it is that you're using. Just don't chop and change and go exponential one time and simple the next. Same with your periods. Right. So at this stage, the indices is trading just above that 15 period moving average, 15 week. That's okay. It did slightly close below it. For me, I would just be having a little bit of a cautionary sign. You can see that they're starting to perhaps curve. Whether they're just going to curve and then rally on again, who knows? But that's just something that we do need to keep an eye on. At the moment, I'm not looking at buying any new shares in the New Zealand stock market. I've sort of got the main performers that are driving the market at this stage. So there's sort of not a lot of opportunities at the moment. But that's what we're seeing there. So it is trading above both of those. It is starting to curve. Whether it falls from here, who knows? I'm not into that speculating. Let's go on to the 1-year chart. Now, this is painting quite a different picture. You can see that for last week, the New Zealand share market has closed below both of those moving averages. And if you look here, the 15 period moving average is getting awfully close to the 30, which is now moving on to a daily chart. Now, that could be indicating that the market is going to lose its momentum and head down. Obviously, last week it started to do that, and we saw that on the 5-year chart with that one red candle. If you follow me regularly, I like to do my research on a weekly basis when I'm looking at investing, but I like to just move over to the daily basis, in which case it's the 1-year chart, just to see what's happening on a shorter time frame. Reason for that is obviously the 1-year chart, because it brings up daily candles, is going to react to market conditions a lot quicker than what the 5-year chart is. So I do base all my research on that 5-year chart, but I'll go and take a look at the 1-year chart just in case that is indicating something that I'm not privy to on the weekly signals. And this is a prime case of that. So if I look at this, because those moving averages are just about to cross, again, they could get really close and rebound off again, who knows? But because the indices is trading below both of those moving averages, it's definitely a warning flag for me. So for me, I would not even be looking on this basis to look for any individual stocks on the New Zealand share market at this stage. Certainly doesn't mean to go and sell what you've already got. Keep holding those, but look to use stop losses. And make sure you do abide by them, because a lot of people out there, in fact, I was reading an article over the weekend that a lot of people will sell their winners because they don't want to give a profit away, yet they will actually hold their losing stocks for a lot longer. Apparently, according to this article, hold losing stocks for about 70% of the time, happy just to keep writing them down, whereas only about 30% of people will actually sell a losing stock. So that's quite interesting. Whereas the opposite happens when a stock is trading well. About 70% of people will sell out quite early because they're afraid of giving back that profit, and they miss further opportunities. In share investing, share trading, you are probably going to have more losers than you are winners. But if you can ride out your winners for longer, then that is what can make you a lot of good money in the market. So like I say, it's about using those stop losses as the share price increase your stop loss, and then that protects you. For me, I find it really easy. It takes the emotion out of the market and anything like that. I could be out doing anything and those stop losses will just run their course. And I find it simple. If you want to learn more about those, by all means, again, sing out. Happy to do so. Happy to help. So anyway, I'll stop sharing. Not too much more to report there on the New Zealand market. But if there is something that you would like to learn about, if there's a share you'd like me to review, by all means do that. And on Thursday, we're actually going to look at a couple of the Schwab investments. So one is the dividend ETF and another one is the high conviction stocks. So come back on Thursday and we'll take a look at that. So until Thursday, take care.